Good afternoon, class. Today we're going to discuss Chapter 4, Income Statement and Related Information. We're going to discuss the uses and limitations of the income statement, describe the content of the income statement, how to prepare an income statement, and explain how to report various income statement items. And so the income statement, usefulness, it helps to evaluate past performance, predicting future performance, and helps assess the risk of uncertainty of achieving future cash flows. Its limitations: companies omit items that cannot be measured reliably. Income is affected by accounting methods employed, and income measurements involve judgment. The quality of earnings. And so companies have incentives to manage income to meet or beat Wall Street expectations so that market price and stock increases. Value of stock options also increase. And so quality of earnings is reduced if earnings management results in information that is less useful for predicting future earnings and cash flow. So describing the content of the income statement. And so the elements of the income statement: revenues, their inflows, other enhancements of assets, or settlements of its liabilities that constitute the entity's ongoing major or central operations. And so examples of revenues can be sales, fees, interest, dividend, and rent. Expenses are outflows or other using up of assets or incurrences of liabilities that constitute the entity's ongoing major central operations. And so examples are cost of goods sold, depreciation, interest, rent, salaries and wages, and taxes. Then you have gains and losses. So gains: increase in equity, net assets from peripheral or incidental transactions. Losses: decrease in equity or net assets from peripheral or incidental transactions. And so gains and losses can result from the sale of investment or plant assets, settlement of liabilities, or write-off of assets. Preparing an income statement. And so your intermediate components. And so the format referenced to is a multi-step income statement. And so it separates operating transactions from non-operating transactions. It matches costs and expenses with related revenue, and it highlights certain components of income that analysts use assessing financial performance. And so common for companies to present some or all of the following sections in totals within an income statement. So they normally have an operating section, non-operating section, income tax, discontinued operations, non-controlling interest, and earnings per share. And so here we have an example of Cabrera Company income statement for the year ended December 31st, 2017. And you have, first I'm going to highlight the operating section, which includes sales, cost of goods sold, gross profit, operating expenses and selling expenses, and your administrative expenses, ending in your income from operations. This is considered the operating section of the income statement. Then you have the non-operating section, which includes other revenues and gains, other expenses and losses, and your income tax. So a single step statement, you'll have revenue less your expenses, which will give you your net income. And so this is considered a single step income statement, while the previous one is a multi-step where you have these different components. And so in a single step, no implication that one type of revenue or expense item has priority over the other. So all your revenues are listed together, all your expenses are listed, and then you have net income, and then your earnings per share, per common share. And notice under expenses, you have your income taxes included in your expense component in a single step. So an illustration: prepare an income statement from the data below using a multi-step form. And so here you have activity listed. The accounts for the activity are listed here. So administrative expenses, selling expense, sales, income tax, and interest expense. And so sales. So in preparing an income statement on this side, you'll have the title, the year, ending date, your first item, sales, which is coming from here, 96,500. Cost of goods sold, 60,570, which will give you a gross profit. Then you'll have your operating expenses, and you'll list them out. Selling expense, administrative expense. So that gives you a total operating expense, and these items are coming from here, 17,000. Next, you have income from operations, other revenue expenses. And so you have rent revenue, interest expense, the total, and then your income before taxes, your income tax, and then your net income. So explain how to report various income items. And so reporting various income items, companies are required to report unusual and infrequent items as part of income, so users can better determine the long run earning power of the company. And so these income items fall into four general categories: the unusual gains and losses, discontinued operations, non-controlling interest, and earnings per share. So unusual and infrequent gains and losses. So unusual, high degree of abnormality, and a type of clearly unrelated to or only incidental related to the ordinary and typical activities of the company, taking into account the environment in which it operates, is what is considered unusual. And so infrequency of occurrence, the type of transaction that is not reasonably expected to reoccur for the foreseeable future, taking into account the environment in which the company operates. Common types of unusual and infrequent gains and losses. So losses on the write down or impairment of receivables, inventory, property, plant, equipment, goodwill, and other intangible assets. Restructuring charges, gains and losses from sale of abandonment of property, plant, and equipment. Effects of a strike, gains and losses of extinguishment of debt obligations, gains and losses related to casualties such as fires, floods, and earthquakes, or gains and losses on the sale of investment securities. These are common types of unusual or infrequent gains or losses. So here we have a number of irregular items reported recent years by 500 of the largest companies. Just to give you an illustration, restructuring, 202, and write-downs, gains and losses on assets, 289. And so discontinued operations, they occur when two things happen. A company eliminates the results of operating of a component of the business, or the elimination of a component that represents a strategic shift having a major effect on the company's operations and financial results. And so amounts are reported net of tax. And so to give you an example, KC Products Incorporated, a highly diversified company, decides to discontinue its electronics division. During the current year, the electronics division lost $300,000 net of tax. KC's products sold the division at the end of the year at a loss of $500,000 net of tax. Show how the discontinued operations would be reported on the income statement for KC products. And so income from continued operations is listed here as $20 million. Discontinued operations, you'll have the loss from operations net of tax of $300,000, and then the loss of disposal net of tax of $500,000. And so that $800,000 loss will reduce the $20 million to $19,200 on your income statement. And so here, discontinued operations are reported after income. From continuing operations, without a discontinued operation, this line item would be net income. So instead of this line item being net income, you have a discontinued operations section. And this is a different scenario where you have a pizza division. And so the pizza division has income of $54,000 and then a loss of $90,000, which is a net loss of $36,000. And you reduce that from the income from continued operations, which will give you net income of $240,000 on this income statement. So intraperiod tax allocation. And so the allocation of tax within a period helps users understand the impact of income tax on various components of net income. Intraperiod tax allocations is used for income for continued operations and discontinued operations. So, an illustration: Schindler Company has income before income tax of $250,000. It has a gain of $100,000 from a discontinued operation. Assuming a 30% income tax rate, Schindler presents the following information on the income statement. And so, income before income tax is $250,000. The income tax is $75,000. Income from continued operations. So you have a gain on discontinued operations of $100,000, less the tax of $30,000, which gives you a net gain of $70,000. That would be added to the income from the continued operations of $175,000, which give you a total net income of $245,000. So discontinued operations, a loss. So in this scenario, Schindler Company has income before income tax of $250,000. It suffers a loss from discontinued operations of $100,000. Assuming a 30% tax rate, Schindler presents the income tax on the income statement as shown. And so here, again, you have $250,000 for income before income tax, $75,000 income tax, which gives you an income from continued operations of $175,000. For your income from your loss from discontinued operations is $100,000, and then your tax reduction is $30,000, which gives you a total loss of $70,000. And that total loss is taken from the income from continued operations, which will give you net income of $105,000. So reporting various income items, non-controlling interest. When a company owns a substantial interest, generally greater than 50%, in another company, GAAP generally requires that the financial statements of both companies be consolidated together into one set of financials. The non-controlling interest is the portion of the equity interest in a subsidiary not attributed to the parent company. And so what ends up happening is, like in this illustration, assume that Coca-Cola acquires 70% of the outstanding stock of Koch Company. Because Coca-Cola owns more than 50% of Koch, it consolidates its Koch financial results within its own. GAAP requires that net income be allocated to the controlling and non-controlling interest. And here they're just showing the total consolidated net income is $7,124,000, less net income attributed to non-controlling interest. And so the net income attributed to the stockholders of the Coca-Cola Company is $7,098,000. And so the non-controlling interest amounts are not an expense or a dividend, but allocations of net income or loss to the non-controlling interest. So this is very important, earnings per share calculation. And so I would keep this slide or write this information down in my notes. A significant business indicator. It measures the dollars earned by each share of common stock, and it must be disclosed on the income statement. And so here, you compute it by taking your net income divided by preferred dividends, must be preferred dividends, divided by the weighted average of common shares outstanding. That's how you calculate the earnings per share, which is the last section on the income statement. So here's an example. Lancer Incorporated reports net income of $350,000. It declares and pays preferred dividends of $50,000 for the year. The weighted average number of common shares outstanding during the year is 100,000. Lancer computes earnings per share as follows. And so it has $350,000 in net income, less $50,000 preferred dividends, divided by the $100,000 shares, which will give you an earnings per share of $3. That's the end of this presentation. Please reread the chapter and take advantage of the other material listed.